Hello, this is Tom Cloud with my bi-weekly precious metals market update. So much has happened in the last 3 weeks. Actually, it's been 3 weeks instead of 2 because I ended up going for a little R&R up in the mountains of Virginia and West Virginia, playing a little golf and talking with 8 old fraternity brothers from 50 years ago. So it's quite a week much needed. But anyway, to get right back to the questions from last time I did this, we were talking about money managers and what they were doing if Biden was president or Trump was president. And certainly everybody's got a different opinion. It's interesting talking to financial advisors. I talked to a few before I left, and I've talked to 2 more since I got back. People managing over $700 million, $1 billion, and what they're looking for in the new year. And there are a lot of things that come out, and we talked about 3 weeks ago, but let me highlight a couple. One thing that nobody disagrees on is that if Biden wins, it's going to be bad for the manufacturing jobs coming back to America, that Trump has been so successful in bringing companies home and doing so well. But with the ties that Biden has had, whether you like it or don't like it, he's had these ties with China for many years of being a politician. So he would be easily persuaded to leave certain things offshore rather than bring them back. Certainly, in my opinion, not good for the American economy. And then certainly the tax rates are the main thing that everybody talks about. And the main one is the corporate rate. If the corporate rate does not stay at 15% with a very wounded economy we already have because of COVID, this could really be awful, because if he raises corporate taxes back to where they were in the 35% range, it is absolutely very, very destructive. So especially with an economy as fragile as we have right now with unemployment, even though it's coming down, it's still double what it was at the end of last year. We only had a 4 something, now it's a 9 something unemployment rate. So once again, not a good scene. But the one that seems to bother us, the tax-paying people, is the tax coming back on your estate. I mean, this could be huge because there's so many people worth over $5 million in this country and had to go back and start paying. I mean, I wouldn't get into it. It'd be a topic for another day. But we all know, we all have common sense to know that if the estate tax comes back to help fund some of these programs and some of these radical programs, it certainly could be bad for the economy, but very good for gold, as they can't print money gold. Gold's coming out of the ground about 1/9 as quickly as we're printing money. So it is a little bit scary and something to do. The other thing that we were talking about 3 weeks ago is we've now seen Bank of America come out, say their target for gold by the end of next year is $3,000 an ounce. Warren Buffett, who's never been a big gold advocate because he likes to build companies, buy companies, sell companies, has put a major amount of money into gold. The great thing for you is we've had a little bit of a lull period after the big moves in gold and silver that we've had. So right now we've seen the dollar that went down about 10.8%. We saw gold go up 6%. For every 1%, gold went down. So we saw it go up about 65% total on a 10% drop in the value of the dollar. Now, the dollar the last 2 weeks has come back up 2.25%, and you would have thought gold would drop 12 or 15%. It's dropped 3%. And right now it's loading to go much higher. We think it's loading to go much higher. We think we could easily see 2,000 by the end of the year, which is only another 3.5%, which would be a great move. if you're making 1 to 1.5% a month, that's an incredible yield. And that's what we've been doing, except we've been making 2% a month for like 16, 18 months. So now we're seeing everything reloading in the next wave. I haven't talked with one financial advisor that does not plan on increasing their clients' money in the gold arena once the dollar starts back down. It's around 92, and once it breaks below 90 again, watch out, because if it goes down another 2%, we could be looking at a 10% up for gold, and then you're at 2,100. You're not at 2,000, you're at 2,100. We still advocate that there will be a 50 to 1 ratio between gold and silver. It's still hanging in there around 80 to 1, and we still think the most logical numbers are $50 for silver and $2,500 for gold when it becomes a 50 to 1. So both of them have room to make a move. About a third of the calls I get are about when do they sell their silver and buy gold with it, because we all know that gold is going to be figured into the fix eventually when there's a new currency worldwide backed by partial gold or all gold. I don't know. But I know it's going on right now from the people I talk to, our contacts around the world. So just watch it, but certainly when silver hits 50, because it has already 2 times, a lot of people are going to want to come out just because they don't think it goes higher. Others see the tremendous demand in the industrial world for silver, so they think it's going to go to 100, 200, even $300 or $400 an ounce. I'm not calling for that right now, but I think we're going to easily see the 50 by the end of next year, and it could be by the end of this year, depending on what happens out there. But when it gets there, if the economy is still printing, the government's still funding everything in the world, they're putting money out there for unemployment, extension, COVID, money to help the economy on the real 1 month, 2 month type deals. So you just have to look at it, but certainly gold is the one that's money. Gold is the one that'll be part of the solution to paper currencies printing around the world like drunken sailors. So yes, you want to get as much gold long term as you can. Premiums right now are very, very reasonable. So you need to be looking at it right now. But the other thing I get the most questions, and this will be the last one we deal in today, is going to be the debt markets. Interest rates can't go any lower. So as they go higher, bonds are going to start going down. If you own bonds, stay in triple and AA rated that are tax-free. You're still making a good 2 or 3% tax-free off of that. That gives you about a 4.2 yield. Those are okay for right now. It's the higher, lower rated A and the triple Bs and those kind of bonds. As the interest rates go up, the principal on those bonds go down. We have seen every advisor I've talked to either says, I'm staying in the triples and AA rated, but I'm coming out of the high yield bonds, and all that money's got to be repositioned. So we've covered a lot of things today. I always appreciate your kind comments. I appreciate you sending questions that we can elaborate on, and we're going to keep moving forward. I still believe that this there's not a cure for this COVID as easy as some people. Hope I'm wrong. I hope there is something that comes out. But even if it does, it's not a return to tomorrow. It's still a year or 2, 3 years to get back to where GDP was in 19. None of the stockbrokers want to talk about it. So you can't run prices up at something that's 80% of GDP from only a year or 2 ago and expect you'll be so overpriced on the equity markets. So yes, buy equities, buy them astutely, buy them for people you feel confidence in, or friends that you feel confidence listen to their list, because we do know there'll be a lot of stocks that'll do well. But we also know the indexes are not going to be nearly as good. So with that, and this market update, I'll be talking to you in 2 weeks. So Tom Cloud signing out.